Hi, everyone. Hi, Chris. How are you?
I'm doing great. How you doing, Deanna?
I'm great too. Thanks for coming on. I just want to tell everyone we are on the flip side, and we are doing today's real estate topic is going to be insurance and understanding how insurance can help us as real estate investors and even what we can do with it with our property. So I'm so excited to have Chris Salmans on to share his knowledge and help us out to make better decisions and see if getting insurance is a good decision for us. Thanks for coming on.
No problem, and thanks for having me. I'm looking forward to our topic today, as it's probably a topic that's not so familiar with many of the people that are on this today. So look forward to diving in, and hopefully we'll have a great time.
Awesome. So yeah, do you want to share your screen?
I will share my screen, and I do have a few slides as we'll go through, as some of today's topic might be a little more detailed, a little more granular than some. So let me just get it set up here, and we'll go from there. So if you could just let me know when you can see it.
Oh yeah,
should be fine there. Okay.
Yeah,
and let me just
I can see also
and I'm just going to make sure to share my audio as well, because we're going to do a video as we get going here in a second. So just to introduce myself for a second to your viewers, my name is Chris Salmans, and I'm a financial planner. I work under the brand of Sun Life Financial, and my specific office, we're focused on working with highly successful professionals. Some of those are incorporated and non-incorporated, and really to keep more of their money and secure their income. So that's kind of our goal. And I'm really excited because our audience today is focused around real estate. And I personally am a real estate investor as well. And so I feel like this is a great audience for me. And we're going to be talking today about the topic of life insurance, and really using life insurance as an asset class. And we'll go through a little bit of the different types just so people are familiar. And some people might be familiar of one area of life insurance, but maybe not all the areas. And really the benefits, like the significant benefits that go to people who are running businesses, investing, self-employed or incorporated, which is really our focus in our business. So our topic is this idea of life insurance as an asset class, and which many people might not be familiar with, but is becoming a very, very large topic in our industry, and I think for many wealthy investors. So we're going to dive into that today. And because I work for Sun Life, obviously there's lots of disclaimers, from legal department about, this is just advice. That's general in nature, not specific. And like I said, if you want to talk in specifics, we're happy to do that at a different time. But let's just dive into a video here. And I'm just probably going to jump over to a different window here so we can actually pull this up. So just bear with me for 1 second. I'm going to share a video here, and just Deanna, just give me a thumbs up when you can hear it. And I'm going to share my screen, and we'll just listen to part of it here. So just 1 second. Okay, perfect. Now I think we should be sharing, but let's just make sure the audio comes through okay.
As a wealthy Canadian, you're likely paying a lot of tax, and your estate could pay a lot more upon your death. Protecting the value of your estate upon your death while not sacrificing the access to your investments while you're alive is a challenge, but it's also an opportunity. One increasingly popular option today is to integrate the estate benefits and cash values of permanent life insurance into your overall portfolio investment mix. Permanent life insurance is often considered a good asset because it can offer tax-preferred cash value growth while you're alive and helps protect your estate, since there is no tax to pay on the policy's death benefit. And with the permanent insurance, you don't have to sacrifice liquidity because you can access the policy's cash value. Permanent life insurance can offer access to a range of asset classes that include higher yield assets, such as private fixed income, not typically available to retail investors. Think of permanent life insurance as an alternative asset class to traditional fixed income types of investments. As an asset class, it can offer a great mix of after-tax returns and liquidity.
And we'll stop it there. But I thought that was a good summary just for us as an introduction to get started today. And there really, there's lots of different things about insurance in our industry. And we're going to hone in on one sort of area, and that is permanent life insurance that we use as an asset for us that's going to do multiple things. And we're going to dive through those individual things that permanent life insurance can do. So let me just jump back here to our slideshow, and hopefully we'll be fine. Hopefully the video won't play again. Just bear with me, and we'll go from there. Just 1 second here. There we go. So just, some things around life insurance and permanent life insurance are really what it can be used for. And life insurance has tons of sort of misconceptions or myths around it. And there has been very many different iterations of life insurance. So we're going to maybe dispel a little bit of those today, and just kind of give you a clear understanding of what life insurance can be used for now. But these are kind of some of the general topics or general categories that life insurance is good for. And so, and these are kind of general in nature, and we'll break them down. So anybody that has what's called a terminal tax liability. So that could be terminal, so on our death, and there could be taxes owing. And that's really where life insurance can excel, making sure that our taxes can be, dealt with at that time, as well as someone who has a company that has large assets within a corporation, as well as someone who has sizable investment assets in safe assets. And real estate in some ways would be considered a safe asset. Those are kind of the three categories, general categories that benefit from kind of life insurance. But more specifically, just before we dive into how we can use this from a real estate perspective, we're going to just general for a second, in the fact that most people think of life insurance in these terms. Early on in life, I might have a lot of debt, or, I might have 3 kids running around like myself, maybe a spouse that will need spousal support. And so we have large life insurance policies for these types of events, and they're legitimate, and life insurance can fill these needs. But there's also this other concept that most people aren't familiar with. And this is the idea of financial capital. And the idea that life insurance can help protect one's net worth. Or if we think about it in these terms, someone's sort of all the things that they've built over time. And so you kind of see here, early on in life, we might not have a lot of assets. We might not have a lot of rental properties yet, or investments, or all of those things. But as we move through life, hopefully those things increase and our net worth increases in size. But what a lot of people don't really realize is that protecting the value of our estate is also something that we need to think about, right? Because, people often joke that the 2 things in life that are guaranteed are death and taxes, right? And that is one of those things in life that we do need to plan for. And from a real estate standpoint, as we're a real estate investor, and some real estate investors that we work with want to pass on all the things that they've built in real estate to the next generation. But the thing is that there's taxes or capital gains at the disposition of a lot of those investments. And so when we look at sort of life insurance can be used in a bunch of different ways, but one of them is making sure that our estate is protected and not lost, really a significant amount of it to the CRA or, some other things there. And life insurance allows us to have what's called a tax preferred transfer. Often life insurance policies have zero tax implications, meaning from life insurance, it can go from when I pass away directly to my beneficiary, whoever I designate, with zero taxes. Okay. And that can be used to pay for things like capital gains tax, or can be used to make sure that, we don't have to sell assets. Okay. And, but it can be used for really anything. But the key to it is that it's a transfer from one side to the other side, generally tax-free. Okay. And so how do we think about like, okay, so we have a life insurance policy. And we'll go through like a specific illustration. I know, Diana, that you asked me to do this. We'll go through a specific illustration just to show you how this works. But if you think about like all the things that we've built through life, how do we make sure that we protect it and that it goes to the next generation? And that's where we often find that permanent life insurance is one of those tools. It's not the only tool, but it's one of those tools that we can put in a toolbox to make sure that the next generation receives the most efficient estate transfer possible. So when we look at high net worth individuals, and this is what HNW stands for, when we look at people that have significant assets from a financial planning standpoint, this is just an interesting slide that I wanted to include, in that really high net worth individuals often keep a significant amount, it's about 40% in 2020, in assets that are not subject to market volatility. They're more safe assets. And you can consider life insurance and permanent life insurance in that category of a safe asset, something that's not going to be subject to market changes, an investment type risk. Okay. And it's interesting. Some people think that life insurance is only purchased by people that are not high net worth individuals. But we just stole this, the top 5 policies that went in place in 2019. And I know that this is probably extreme for most people, but I just wanted to help you understand sort of the annual premium here is in millions of dollars that somebody went out and took a life insurance policy in the face amount, so $60 million in the top one, and every year they're paying $12 million for that. And you're like, why in the world would someone do that? And we'll talk about it a little bit, but essentially it's this safe asset that's going to be able to transfer a significant amount of money from one party to the other party with very little tax implications, if anything. And so when we think about someone who's wealthy, we're not thinking about the risk of, oh, I have, young kids I need to provide for if I pass away. We're really talking about what is the way that we can transfer this asset from one person to another person in the most efficient way. Okay. And it's an estate planning tool that very, very high net worth individuals are using. So it's not something that, hey, we have lots of net worth and we don't really need to pay attention to insurance. It's actually almost the exact opposite when we're talking about permanent life insurance. So just generally, before we dive into a specific illustration, but why permanent life insurance? And what does permanent life insurance mean? And like simply all permanent life insurance means is that we have a life insurance policy that will never end until we pass away. Okay, that's the basic concept of permanent life insurance. Okay, and it's very different than many life insurance policies that people hold in Canada. But permanent life insurance, simply, we have a life insurance policy. It'll never end until someone passes away, which means that because it never ends before someone passes away, that it absolutely will pay out when someone passes away. And we call that in the insurance world a death benefit. Okay, so some of the things about permanent life insurance that we have from just like a concept or a construction of the policy is often permanent life insurance has level premiums, meaning that the premiums that we pay, they're the same for life, meaning the dollars that you pay, the same for life. They generally will have cash value, and this is where we're kind of building to what cash value actually does and how we can use that from a real estate standpoint. But cash value is simply, if we talk in real estate terms, the equity that's usable within a life insurance policy. Okay, so it's this concept, this dollar amount of value inside of a life insurance policy that can be used while someone is living for their benefit. So it's kind of like, some people joke that life insurance is meant to be used while you're living. And that's what they're referring to is the cash value, the asset that's built into this policy. And for real estate terms, it is the equity that you would have in a home, right? When you first buy a home, you generally have a mortgage, or a rental property, you generally have a large mortgage, and that's really not yours if you sell the home. But as you pay that off, you grow equity, or as that home grows in value, you grow equity. And that term can be kind of used for cash value in the insurance standpoint. But also, a lot of life insurance policies that are permanent, they actually grow in value. And if you're familiar with many investments, often that growth is subject to tax. But life insurance generally grows as either tax-free or deferred growth, meaning it's not taxed until you use it in some respect. So from a tax standpoint, it's an amazing tool to help build wealth without losing a significant amount of that in tax. Okay. And I don't know why there's a little note bubble there, but what's that supposed to say is a CDA credit. And if you own a corporation, you're probably familiar with the capital dividend account. And from a corporation standpoint, it allows life insurance proceeds to flow out through a CDA credit tax-free, which means some of the largest life insurance policies that we hold or sell to clients are corporate clients that have corporations that have significant assets in them, and they're looking for ways to flow that out to their shareholders and beneficiaries. Okay. So those are kind of, I hope we didn't lose everybody. I hope some of this general insurance kind of, jargon is there, but, we need to build a little bit of a foundation as we go forward, what we're really talking about. And so when we look about permanent life insurance, you can have something called participating permanent life insurance. And what that means is that it's an insurance contract. So it's an insurance contract, but within that contract, there's an investment account. Okay. And Sun Life calls it its par or participating account. There's lots of billions of dollars in this account. And that investment account pumps out what's called an annual dividend to the policyholders. And that annual dividend does a few things. It increases the death benefit. So your policy that you originally purchased, the value of it will actually increase, the death benefit will increase, but also the cash value, which we talked about, that's equity, within these policies also increases. And that's where we start to build a significant asset. And remember that building in the contract is non-taxable on an annual basis. Okay, it's not subject to tax. And in this kind of concept, people don't really realize that this really is another asset class that most people haven't really been taught or discussed about. Like we know real estate, this is a real estate group, right? We generally know stocks and bonds and those types of things, but a lot of people don't really understand that insurance can actually be a large separate asset class that is there to use, okay? And has some really unique benefits. Just briefly on Sun Life's par account, okay? So this is the investment account within the life insurance policy. The yellow line is the actual rate of return of that account since 1994. And this account has been around since a significantly long time. I think it's like 100 years or something that they've used this account. But this is over the last sort of recent history. And it's basically its average rate of return, I think, is somewhere north of 7%, 7 or 8%. And you can see that line. But the gray line here is the S&P TSX composite. And that's what that actual rate of return has been during that same period. So it's had significant volatility, whereas the par account has had a phenomenal rate of return, but its volatility is very, very small. It's very consistent and conservative over time, which another asset class is providing a lot of downside protection for clients who are building wealth. So, okay, so we're going to look into how this kind of par or participating life insurance actually works. And there's kind of two illustrations here. So if you can look down at the bottom here, and Deanna, feel free to jump in if you have any questions or you want me to stop and hone in on something. But basically, if we took a 50-year-old client and he bought a $700,000 participating life insurance policy. He decided, he's going to put $50,000 in a year. Could be whatever, could be $10,000, could be more, could be less. Like, it doesn't matter. This is just an illustration. And he only pays for it for 15 years. Okay, so he's only paying for it for 15 years. Mortgage concept, right? We paid off our home early. Same thing in life insurance. We can have a predetermined payment period. And so you're going to see a few things here. The blue is what's called cash value. That's our equity. And the yellow is going to be our death benefit. Okay, and you can see by year 5, that $700,000 policy in our illustration here is north of $1 million. And we've started to already build significant cash value. It's probably around $150,000 there in cash value. And you can see by year 20, we have a death benefit. So this is if this client passed away at age 70, that there would be almost $2.5 million that would pay out to his estate. But he has a cash value there north of $1 million in this scenario. And the longer he lives, obviously, the dividends just keep pumping in, and the policy value grows and grows and grows. And generally, a lot of these PAR accounts kind of equal the cash value and the death benefit at age 100 is kind of a magic number. But if you see, even if he lived to age 90, his estate or his beneficiary, generally we would direct it straight to a beneficiary, is going to receive $3.5 million. Okay, so that's the death benefit. That is if he passes away and doesn't do anything with the policy. But if you hone in on the cash value, that's that blue line there. This is what's really interesting. Okay, and cash value, I think it's on my next slide. Oh, where did it go here? Yeah, my next slide. We can use cash value in a bunch of different ways. I don't know if you've ever heard the concept of being your own bank. There's lots of TikTok videos and YouTube videos and all these things on this, but it's called being your own bank, and using life insurance to do that. And I don't know if I love the term, but I guess it gives you a good visual of what you can do, because that cash value can be used in a few different ways. So, and they're not in any specific order here, but you can cash it out. So you can actually call Sun Life and say, hey, I want to cash out portions of my dividends, send those to me. And they do, just send a check. There's no questions asked. You can do another, what's called a policy withdrawal, which is very similar. But the one that most people use is kind of the last two. And what is called a policy loan. So we'll go back to the real estate concept. So let's say, you bought a rental property. The rental property is, worth $2 million, let's say. And you want to get some cash. You want to withdraw some equity from it. So basically, you go to a bank and you get a line of credit or something, or you remortgage, and you take some of that equity back out and you receive it in cash, and then you can use it for whatever you want, whether it's your next flip or rental property or whatever it is. So in life insurance, it's actually very similar. In life insurance, you could take a policy loan against the value or the cash value. Okay. There's no qualifications for it. The only qualification for it is based on Sun Life's calculations that dollar amount has to be there, and you receive a statement showing you what the potential loan value could be on an annual basis. Call up your advisor and say, I need a loan of this amount against the policy, and we send that to you. Now, there's a tax calculation in the background, so a lot of those policies can be tax-free, and then some could be subject to some form of tax, depending on that calculation. It has to do with how long the policy is in force, how much is there, a bunch of different things. But there's no qualification, so you don't have to get pre-approved like you would from a mortgage, if you got a line of credit or you remortgaged. So there's no qualifications. It's simply a value there for you to use. One of the also differences from taking a policy loan is they do have an amount that you could pay back, but there's no prepayment requirements on policy loans, which means the policy loan could just build up over time. So it is a loan, so there is an interest rate attached to it, but you actually don't have to pay that off. And if you never pay it off, really what happens is, if we go back to slides here, the death benefit, when it's paid out at the end of the day, if there's a large loan on the policy, would pay off the loan, and the rest would go to your beneficiary, spouse, partner, whoever it would be. And so by taking a loan also, though, it doesn't stop the dividends. So the investment of the policy will still be running over time, creating more value in the policy, even though you've taken out a loan against it. And if you want to pay off the loan, whatever you did with the money, whether it's an investment, it's done, all those things, you can pay that off. But it essentially is this idea that you've created an asset that you can access with no real questions asked, and you can use it for whatever you need. Okay. Any comments or thoughts on that, Deanna? Are we good to go to our next illustration?
I was just going to say that I found that really amazing about this, and that you can just pull out the money, which it kind of makes sense, because I remember you were saying, like, you're pulling out technically is your money that you're pulling out, so you don't really need to go through the checks like you would if you're going to a loan, because you're pulling out your own money. And like you said, even, which I think for investors, it's amazing that you don't have to, let's say, pay it back, let's say monthly or anything. You can decide, like, I would just think in a real estate investor perspective, let's say you need money on a project, you're like, oh, I have 50K in my life insurance, let me pull that out. I don't have to even worry about making those payments, because let's say I'm doing a flip or a BRRRR, something short term, and then I put it back in 6 months to a year, and then the interest just goes and then it just, even if you just either you pay back like the amount plus interest, or you don't, whatever you decide. But it's nice to have the options that either you don't pay back, you do pay, let's say, the 50K back, or you even pay the 50K back plus the interest. And so it just gives you so many options to work with, and yeah, you don't need to have credit. So I just wanted to restate that, because I think that's very important and helps investors to kind of think of like what to do with it, and how they can, put it into their projects. And like that, because sometimes if you're working on a flip, or let's say like that, a BRRRR, where you're doing renovations on a property, there's so many expenses involved in that period of time, because you're dealing with everything, right? Utilities and renovation costs and just everything, that if you can just relieve, okay, at least, and then the mortgage, and if you can at least relieve, for example, not having to pay, let's say the construction loan part was, let's say it's 50K, then at least kind of like gives some, like relieves some stress from the person. Because like, okay, I don't have to, at least I can pause that. Whereas, others may, if you stop paying your mortgage, they'll probably be like, well, we're going to just take the house from you.
Yeah, we got the house, right? Yeah,
absolutely. Or if it's like, you can't be like, hey, can I just like not pay my mortgage for 6 months? They probably won't let you. Or same thing, if you tell like your contractors, hey, can I pay you at the end of the project? Most likely that's a no. And probably absolutely. A strong one.
Absolutely. And like the cool thing about, permanent life insurance and cash values is, there really isn't a stipulation for what you're using the money for. And, if you got a construction loan, obviously there's so many checks and balances, and so many business owners, when they're going through big projects, money tightens up, and banks, get nervous about, all these things, right? So, life insurance is that other tool. It's not the only tool that we use, but it's that other tool that there's cash value there. It can be significant if we structure the policies right. And, it has that benefit of a tool that you can use now, and a tool that's going to be significant later. Because it's not, this is one of the concepts that's a little bit hard for people to get, maybe their head around sometimes, is that, well, what am I using it for? And I would say you're using it for so many different things. Yes, the cash value is there for you to access as an investor, but also at the same time as you're using this amazing tool for, investment or all these other things, it's also going to benefit your estate significantly later on, right? And that's what's really cool about this. It's, this tool that can be used for so many different reasons that can really, I think, be just an amazing opportunity for people, as they go through. And there's another example here, just a little bit different. What I just ran here, I just ran this one today on, I think I did it on a 40 or 45-year-old, 45-year-old here. And just said, hey, if we put, $10,000 into a permanent life insurance today, and there's a bunch of different criteria that go into life insurance, how we get our pricing, male, female, smoker, non-smoker, those types of things. We don't have time to get into all that, but so $10,000 a year, so $900 a month or whatever, but we only do that for 20 years, so it's a limited pay, so we're not going to do that forever. But this is what it would kind of look like from a death benefit standpoint. If someone lived to let's say 90 years old, and they put in, let's say, over that time, we got 10,000 a year for 20 years, we're at 200 grand or something like that. The policy at 90 years old, the death benefit is going to be north of $1 million. So what's the X on our money there? Like it's huge, right? But then also from a cash value standpoint, this is the next slide, total cash value in that exact same scenario. We're building cash value that starts at zero, but then over our, lives, that cash value builds up significant. And the earlier you do this, the better it is, right? The younger you do this, the better it is, but it can really be done by anybody. And this is only one illustration. There's so many ways we can structure this to make it valuable for clients. But the concept is that life insurance has some unique benefits, and we can access those in different ways depending on the client needs. And that honestly, the wealthier you are, some of these options just become so much more interesting because of deferred tax growth or no tax payout or tax on life insurance proceeds. Like there's so many really interesting things that for high net worth or investors or business owners that can be done. We don't have all the time to go into those today, but the last one just here, point number 4, I'll just say, is sometimes people don't want to take the policy loans directly out of their policy from Sun Life. And so they can actually have the policies assigned collaterally to different lending institutions than to go get more traditional loans using the life insurance as the asset in the background. Okay, so there's lots of different things, and we do that for a lot of corporate business owners that want to, or need to, depending on the values of loans that they're getting with their business, use their life insurance policies as collateral. Okay, so let me just jump here. Oh, there we go. The average dividend rate of return on these PAR accounts in the life insurance policy since, the last 25 years has been 7.46%, which is significant when you think about some of the years that we've been through. It compares the S&P TSX, which on average over that same time period was just slightly higher, but with all the volatility. Okay, and so there's just some interesting things. I think the last one here, I don't know if I want to dive down this, but I would just say for corporate clients that have corporations that have retained assets in their corporation, permanent life insurance can be an amazing tool, almost close to a godsend for corporations. Maybe at some point we'll have time to dive into some of those corporate benefits, but I think that's probably where I would leave it on the permanent life insurance side, just with this last sort of exclamation point. When we look at the participating investment account that helps build your cash value within these policies, this is the general breakdown that Sun Life has used for decades. It includes some things that we know, like corporate bonds and commercial mortgages. They actually hold a ton of real estate, physical real estate within this account. Equities would be stocks, and then private fixed income, which is a unique area that a lot of people don't have access to in Canada. To do this. So the investment account is significant, and that's why it's had such stable returns over the last 25 years, is that it's unique in its makeup. Okay. And it's allowed the Sun Life Par account to pay out dividends to our clients at such a stable rate. When you think about this, or last year, 2022, the stock markets were way down. 2020, we had COVID, stock markets went way down. 2008, stock markets went way down. And at the same time, the Par account has just been consistent through time. So that's really the back end that helps build cash value. And the last note, I think, here is, why would we do participating insurance through Sun Life? Now, we work with a lot of different companies, but Sun Life really is unique in its makeup from a company standpoint. There's lots of accolades. Sun Life continually is voted one of the most stable companies in the world by the Global 100 list. And Sun Life itself, operates very conservatively, and every life insurance policy they issue is meant to be paid out at some point, but to also have significant benefits for our clients. Okay. Any questions before I wrap us up that you wanted me to go over, that you thought would be important, Deanna?
No, I think you've covered it well so far. Like you're saying before you get into the example, right?
You know what? These really, these really are. And I can pull up the illustrator if you want. If you want me to pull up the illustrator, but these are the back end of those illustrations. Would you like me to pull up an illustrator, do a live illustration?
No, we don't have to do it. Sorry, I thought
that's fine.
We don't have to do that.
Yeah. So this is really kind of the back end of how those work, and how policy values would work for clients, and how your death benefit would grow, based on different ages. And this would be the cash value sort of criteria. Now you can kind of see their dividend current scale, dividend minus scale. They always, in dividends, they're never guaranteed. And so they show some illustrations there. But current dividend scale right now just went up again, and it's at 6.25, I think, is what it is. So yeah. Hopefully it
makes the interest rate go up and down for.
Yeah. So when it's not like everybody would be used to right now with interest rates in the Bank of Canada. So Sun Life, it's not an interest rate that clients receive in the Par account. It's a 1-year dividend payout. And that dividend payout pays out to the policyholders that hold these Par accounts. Okay. And it's based on the rate of return from these assets that you can see here. So that's why when interest rates were so low in Canada, like basically non-existent, Sun Life still paid out a dividend of, it was basically 6.5 to 6%, depending on the year during those low interest rate years. And that's how they still paid out, a 6% rate of return, is that it's not solely based on interest rates. They do have a component in the portfolio, but it's pulling from so many different other asset classes that many people just don't have access to. So that's what has made these policies, one of the elements that have made these policies so attractive, is that it's a very consistent rate of return over time.
And it's like many products in one, because it's like life insurance. It's kind of acts like a stock because you get dividends, or but then it can act like a loan if you want to pull out money from it and use it for whatever you need. So I find it's very interesting, and and like that, and for the future, it is your life insurance, if you like when you need it. So it's a very interesting tool to have that just has many different components to it.
Yeah. And I would say, like, from a real estate specific standpoint, and I would echo every point you just said. And I would also echo a lot of people like myself, eventually want to, have real estate transition to, kids or next generation. But, on, their death, there's significant amount of taxes in the form of capital gains. And by having a permanent life insurance that also pays out at the same time as death, it's there to pay for all those capital gains so that we don't have to sell properties to generate cash to pay taxes. And, that's a scenario that happens in family cottages, that people often have to sell the family cottages to pay for taxes. It's a scenario that pays out in investment properties, as well as some other assets that people hold. And that's where the estate standpoint comes in. We've talked a lot about the immediate benefits, but there's also a significant amount of estate scenario that can play as well. That permanent life insurance is kind of one of the only assets that can really help solve some of those problems. So it's a unique product. It benefits from a unique sort of standing in our tax code that generally life insurance pays out tax free to the beneficiaries. And so there's a lot of things that life insurance can do. And that's where it's like when we meet with clients, it's so individual to them. But it's such a unique product that, people haven't really heard a lot about, and really should be talked about so much more, because it's really, really unique, great benefits. And like I said, can be in some ways really changing for a lot of clients that develop this into their strategies.
100%, especially I feel like if you're a real estate investor that has many properties, and like you said, it's you want to disperse them to your kids, but the amount of taxes are insane, or will be insane, to try to just pay all those properties off. And it's funny because you just actually made me realize, remember when I was younger, my father actually told me, he reassured us. He's just like, oh, he's like, when we pass on our properties to us, he's like, you won't have to pay any taxes. I never actually realized until now what that meant. I'm pretty sure that means he has life insurance. I thought he had a different kind of insurance. And so it must have something like that, unless that there may be others. But I remember he told me he did something so we wouldn't have to pay to pay taxes on the properties that we're going to be inheriting.
Yeah, and a lot of the tax code in Canada, and we work with a lot of accountants and lawyers and to put these things in place to make sure they fit with clients and rely on their expertise. But a lot of people don't really realize that in Canada, the highest marginal tax rate is basically 53.53%. And what happens in an estate is that you have all these assets that come in, and basically when someone passes away, there's lots of different scenarios if there's a spouse and all the stuff that comes into place. But let's say we have one client, no spouse, comes into play. All of his assets, that are taxable are deemed disposed the moment that he passes away. So that would be like our real estate is deemed sold the day he passes away, whether it's not. All his registered assets, as far as RSPs and, investments, are deemed sold that day. And so what happens is all that comes into the estate and can be subject to tax. And that tax bill, because it could be at the highest marginal tax rate of 53.53%, you lose half of it to CRA, which is just crazy, right? So don't get me started on that. But we're
gonna go down the rabbit hole.
yeah. But it's just good planning, and these things are so easy to kind of put in place. That good planning can really make sure that your next generation can have the wealth that you've built, as opposed to getting siphoned to other places, right? Which is huge. And the cool thing about it from a real estate standpoint is we can use that cash value to benefit us now, and it'll benefit us later. So
And it makes you understand why high net worth people use these products, because it is a very actually investor friendly, and any types of investments types, an investor friendly type of tool to use. Because I have heard, like you said, people that have, millions of dollars and they have life insurance. I could say, not that I looked into it, but I never understood why, because of
Yeah.
what my basic understanding was. But then once you read this and you understand, then you start seeing all the different types of benefits as an investor, what you can do for you and your family to take use of this and take advantage of, you know, the benefits that come with this. And I feel like that's the full definition of an investor, right?
Yep.
We find a tool and we're like, what can we do with this thing
Yep.
to put it to our benefit, right?
Absolutely. Absolutely. And yeah, I think that's one of the biggest myths, is that like as we grow our wealth, that we don't need insurance. And it's not about need anymore. It's putting this tool to use that's so unique, and can have significant impacts. And you're right, as an investor, it's like, how do I use this? Like, how can I use this? How can this be better? And there are a lot of ways that are really unique to life insurance that can really benefit investors and you know, those people that are building wealth or already quite wealthy.
Mm-hmm. Awesome. Any final notes that you like, or you like to
No, I would say the final note is that this has just been so kind of general and surface. So, you know, just like a 3-second plug. You know, if anybody wants to talk, we're happy to talk. We specialize in this area, and we would love to have chat. I think I put some contact information in here. Oh, there you go. There's my contact information, and would love to have those conversations and just see how we can benefit clients and you know, help with real estate portfolios or estates or all those things. So yeah, we'd be happy to help.
Awesome. Thanks so much for sharing. It was so informative. And if you guys love what you heard, Chris will be linked into this video, so you can even DM him directly too if you want to. He'll be in contact with you there. And yeah, let us know your thoughts. Let us know in the comments if you had any questions. Anything else, you know, if you want us to deep dive in other areas, and maybe we do another episode in the future. Thanks so much, Chris. It was awesome to have you on, and we'll see everyone in the next episode. Bye, Chris.
Awesome.
Bye,
Thanks. See ya.
everyone.
Bye.